Talk to us about the structure of tariffs and how they could be changing. You know, one thing that we're continuing to watch as more deals get rolled out is whether or not Vietnam is going to be a template in terms of transshipment, right? How big an issue that is for the U.S. And I think it is a big one, right? 40%. On the positive side, though, what we saw with the Japanese deal is President Trump seemed to almost on a whim, almost suddenly go, look, the reciprocal tariffs, that's baseline. Then we've got the 232, the sectoral tariffs, 25% on autos. Look, this is getting way too complicated. Why don't we just take everything down to 15%? Is this just a one-off, or is it a sign that the template is changing?
I do think the template is gradually changing as more negotiation continues. So, you know, you can always argue the Liberation Day, April 2nd tariff, the baseline 10% plus reciprocal was a starting point for negotiation and then really put pressure on the trade partners to make more concessions. Of course, we know the calculation of the reciprocal tariff is a bit arbitrary, but the reality is if that's a negotiation tactics, it's working. The fact that, you know, many economies that we've seen so far are willing to provide a zero tariff for U.S. imports into their own markets while accepting 15, 19% tariffs for their products going to the U.S. I think from that perspective, you can argue the U.S. have been, you know, getting a better deal from this perspective.
Yeah, and, you know, the other thing I've been watching and trying to figure out, I've been scratching my head, is with everything that's still going on, the trade war, tariff war, wars, Ukraine, Middle East, etc., that still isn't going away, right? Yeah. We still have yields looking actually fairly calm and contained. The 10, the U.S. benchmark, I think we've been averaging so far this year about 440. But take a look, we're actually sub 440. It's not even talking about the long end. We're back below 5% again, which kind of has me scratching my head why, right? And when I take a look further down at credit spreads, they have come in noticeably. You know, are they going to stay there, or for the second half, are they going to blow out again, do you think?
Well, I think that's a great question, because after the budget reconciliation that went through on Independence Day, if you look at the market reaction, is very, very muted. And the fact that we're looking at U.S. budgets continues to be at 6-7% deficits of GDP of deficits for the next 10 years, debt going from 98% to 125, 130. I'll argue that market reaction has been muted, and maybe the investors have already accepted the reality that U.S. fiscal position will continue to build up their debt. And at the same time, I think investors, frankly, do still need income. So, you know, why yield hasn't gone higher, I think is as and when, for example, 30-year going up about 5% or 10%, 10-year yields hitting 4.5%. That's when a lot of investors thinking about, well, you know, I need that income, and still, despite all the fiscal concerns, the U.S. Treasury continues to be the deepest market, the most liquid market. You know, I'm happy with 4.5% yield at 10-year. So I think that helps. But on the spread side, I think investors are also taking calculated risks, because all-in yields, for example, for high yields right now is 7 to 8%. Even if spread does widen, for example, back to the long-term average of around 450 basis points, the negative impact on bond price, or at least at the index level, it's about 3.5%. So net, you are still getting about 3.5% in terms of income. So I think, you know, when you take into account those type of calculations, investors are not neglecting the risk of spread widening, but the level of yield right now is large enough to provide a cushion to protect themselves from some bond price volatilities.
All right, so bonds good for income, and also good if you don't want to stress, because likely in 2H, even with things on the tariff front seeming to calm down, likely we've got more vol ahead.
Absolutely. I think, you know, if you think about all the policies, not just tariffs, on budget, on immigration, on a number of issues, all of these are going to impact on profitability of companies and earnings. Right now in the U.S., earnings performance continues to be really robust, but at the same time, valuation is not cheap. So, you know, I think a lot of investors in Asia and globally, they're looking at ways to hedge themselves while generating income. We've seen, you know, we talked about fixed income just now. We've seen high dividend equities. We've also seen, you know, ETFs, active ETFs with an options premium built in to provide that additional income opportunities for investors while capping some of the downside. So I think these are interesting developments on the product or asset class side that helps investors to manage their volatilities.